learners, welcome to our session today. I am your instructor, CPA Aringo Frederick. It is a continuation of what we were doing earlier on. Remember, we had introduced advanced taxation and we are still looking at topic number 1. And basically topic number 1, we noted that it will be covering the concepts to do with taxation of partnership. In our last class, we had looked at admission of partners. In our today's class, my good students, allow us to talk about conversion of partnership business to liability company, And in that case, maybe just to remind ourselves on what we covered. At this point, we mentioned that anytime I'll be talking of partnership, of course, I'll be looking at the following. I'll be looking at admission of partner in regard to admission, partnership in regard to admission. This case, we mentioned that the same concept, you're going to treat it with the concept of retirement and talk about the aspect of, or rather, let's just have it separate, talk about retirement here, and also talk about what conversion of a partnership to a limited liability, conversion of our partnership business, conversion of our partnership business, conversion of partnership business to a limited liability, to a liability company, to a liability company. So recall that the whole of these concepts, one of the main elements that should stick at the back of our mind, we mentioned that we'll be talking about 2 periods. These are the periods before and after. Before and after. If it is admission, of course, I'll be looking at the period before and after admission. If it is a retirement, I'll be looking at period before and after retirement. The same case with conversion, I'll be looking at the period before and after conversion. So that is one main element that must take at the back of our mind always. Then again, another key element now, coming back to, we are looking at conversion. At this point, we say that we know very well that I'll be having the 2 periods. That is the period before conversion and period after conversion. And also talking about period before and after admission. So our concentration is on conversion of a partnership business to a limited company. It is at this point, my good students, that again we should recall what Mwalimu had mentioned earlier on. We say that the foundation of tax, it will be upon you to always have this at your fingertips. That is allowable expenses and unallowable expenses, taxable income and untaxable income. These concepts must always be at our fingertips for us to handle the concept of taxation very confidently. And the beauty part of it is that Mwalimu has done these videos for you. So you don't need to worry, you don't need to worry. So after that concept, you will find that it will be very important for me to take you through the aspect of understanding, because you had looked at the allowable expenses and non-allowable expenses when it comes to partnership. For us to continue with this concept, I'll also want us to have a brief on the allowable expenses and non-allowable expenses in regard to companies. But I believe you already have the notes. So what Mwalimu will be doing, Mwalimu will be just going briefly through that. So that should take us to allowable expenses. I want us to understand some specific allowable expenses that are considered in company. These are allowable expenses. Allowable expenses. In this case, we're looking at company. Allowable expenses. Talk about allowable expenses. And these are allowable expenses, my good students. We're looking at what? Company. We're looking at a company. We're looking at a company. Allowable expenses. In this case, we're looking at what? A company. So, mentioning that, these are the following specific allowable expenses that are normally considered special for companies, which are not probably taken into consideration in any other business. So, number 1, allowable expense that you can always talk about is, number 1, we are talking about debenture interests. So, in this case, we'll be having what? Debenture interests. These are specific allowable expenses in companies. We'll also be talking about auditing and bookkeeping fees. Number 2, talk about auditing and bookkeeping fees. auditing and bookkeeping fees. Auditing and bookkeeping fees. Okay. Number 3, my good students will also be talking about the concepts of what director emoluments and expenses. Talk about directors emoluments and expenses. Ideally, those are just like fees, right? Number 4, key element that you must also consider is the cost of issuing shares or debentures to the public. So talk about cost of issuing shares, cost of issuing shares, cost of issuing shares or debentures to the public, or debentures to the public, cost of issuing shares or debentures to the public. That one is also going to take it as what? As an aspect to do with what? As an aspect to do with a liable expense. Number 5, we can also talk about the cost of an IPO, initial public offer. Cost of an IPO, that one you can also take it as what? As allowable expenses. And of course, we'll always be looking at what? Any other allowable expenses, just like any other business. So talk about any other allowable expense, any other allowable expense, any other allowable expense, any other allowable expense, just like any other business, just like any other business, any other allowable expense, like any other business, like any other business, like any other business, like any other business. So you'll find that whenever you're thinking of any other allowable expense, like any other business, at this point you must be having them at your fingertips. I've given you very brief notes in relation to this, so I believe by now you must be having this at your fingertips. You must be having this at your fingertips. Now, at that point, we've been able to understand the allowable expenses, which are specifically purely for limited liability companies. Because remember, when we'll be looking at conversion of ownership business for liability companies, we'll also be given the expenses which relates to the companies. And therefore, it will be very ideal for us to identify that these are an expense relating to our partnership business, and these are expenses relating to what? Limited liability company. So therefore, that is what we should have in mind always whenever you're looking at these concepts, okay? Now, after we've talked of allowable expenses, my good students, it will also be very wise for us to look at, it will also be very wise for us to talk about the non-allowable expenses for partner, that is of course for companies, non-allowable expenses, non-allowable expenses, non-allowable expenses, non-allowable expenses, non-allowable expenses. It will also be very wise for us to look at what? The non-allowable expenses. It will also be very, very wise for us to look at non-allowable expenses. So looking at non-allowable expenses, my good students, again, at this point, what must we always have in mind? What must we always have in mind? Number 1 item that you must also consider, that you must always consider anytime we are looking at taxation of a liability company. In this case, the following expenses are taken as non-allowable expenses. Number 1, talk about proposed dividends or paid dividends. Proposed dividends or paid dividends. Proposed dividends or what? Paid dividends. Proposed dividends or paid dividends. Such dividends will be taken as what? Non-allowable expenses. The other key element that we're going to take as non-allowable expense, my good students, anytime you're given in company, we'll be talking about what? Corporation tax, corporation taxes, or other corporation tax, or installment tax, or installment tax, or installment tax given. Corporation tax or installment tax given. In that case, you're going to take it as what? As non-allowable expense. And always recall, anytime we'll be having any component of tax, these taxes are always taken as what? Non-allowable expenses. Other key elements specific to companies, in this case, assuming you're having impairment of goodwill, assuming you're having impairment of goodwill, assuming you're having impairment of goodwill, also we are going to take it as what? You are going to take it as non-allowable expense. Impairment of goodwill, you are going to take that as what? As non-allowable expense. Other key element also, my good students, will also be looking at what? preliminary expenses written off. Preliminary expenses written off. Number 4, talk about preliminary expenses. Talk about preliminary expenses. Talk about preliminary expenses written off. Preliminary expenses written off. In the event that you are given preliminary expenses, and the question will be, do you know what preliminary expenses are? This is a good question that you should ask yourself. Ideally, preliminary expenses normally tend to look at the expenses that you normally tend to incur before you start what? Operations. These are what you're terming them as what? Preliminary expenses. So in the event that you're given such expenses, always have at the back of your mind that these are going to be taken as what? Non-allowable expenses, which again, this should stick at the back of your mind very well. The other key element also will be having directors' private expenses. Number 5, talk about directors' private expenses. Directors' private expenses. In the event that you're having such, you should take that one as what? As non-allowable expenses. Other key elements we should be talking about whenever we're talking of company-specific items in companies. Number 6, transfers to reserves. These are a transfer to reserves. Transfer to reserves. Transfer to reserves. Transfer to reserves. Also, if given such, always recall that you are supposed to take that as what? As non-allowable expense. And by the way, this video is not only for advanced taxation students. This video is also very important for those students who are doing intermediate public finance and taxation. For those students who are doing intermediate public finance and taxation, this video is also very important to you, because also at that point we'll be looking at what taxation of limited liability companies. So it will also be very important for you guys to also master search. Probably if you have an opportunity to view us on YouTube, if you have an opportunity to view us on Facebook, or any other social media platform that you are viewing us on. In this case, we should be having transfers to reserves. And of course, number 7, consider any other non-allowable expenses, just like any other business. Any other non-allowable expenses, just like any other business. That concept, again, we must always tend to have it at the back of our minds. Now, after we have talked of allowable expenses and unallowable expenses specifically for companies, other key element that I'll also want us to go through, my good students, and I know this area at times it always tends to confuse a lot of students, but in that, the beauty part of it is that we are solving that today. We are solving that concept in this session of ours today. The aspect of overcast and undercast of our items, or rather overcast and undercast of what? Of our inventory items. This one is also a very common and key concept that you must always tend to grasp anytime you're looking at what? Taxation of a limited liability company. And the beauty part of it is that the concept that you're handling today is conversion. And this conversion, you're converting a partnership to a liability company. So there are some specific elements that if you grasp correctly, you'll find that it will be very, very easy for us. It will be very, very easy for us. And you'll wonder why Mwalimu will always tend to explain all these concepts. Simply because Mwalimu believes that at this point, you are going to clear advanced taxation and you're going to release you at the market, right? So Mwalimu will always prefer that you grasp the concept all clearly, rather than just cramming for the purpose of exams. And that's why Mwalimu will always tend to explain the concepts, so that I believe if you mastered the concept correctly, even if we release you to the market, you will be very, very proficient. Rather than just cramming, doing a lot of questions, and yet you don't have the concept. So that's why Mwalimu will always insist of you getting and grasping the concept correctly. And that's why the reason why Mwalimu is giving us all this background, so that when we start working, or rather when we start solving these problems, it will just flow. It should just flow. But because if you cram, you'll be having a very difficult time to understand how things work. If you are doing, or rather you are revising, just doing questions. After you've done the questions, then you passed what next, and you've not grasped the concepts. And that's why Mwalimu will always tend to insist on the concepts. That's why Mwalimu will always tend to insist on the concepts. So at this point, we are seeing that I want us to look at a scenario whereby I'm given the overcast or undercast of our items. If we are given such, what will we always be required to do, my good students? In this event, I want us to analyze this case. In the event that I'm given the effect of our profit, having either overcast or undercast of certain items. So in this case, I want us to look at this case, talk about in the event that we are having, say, like overstatement of maybe I'm having overstatement of opening inventory. What will be the effect in our profits? Effect to profit, effects on profits, effects on profit. And basically, the effect on profit, we are looking at what? The aspect of our gross profit. So, we're having overstatement of opening inventory, understatement of opening inventory, overstatement of purchases, overstatement of purchases, overstatement of purchases. Talk about understatement of purchases, understatement of purchases, understatement of purchases. Talk about the aspect to do with overstatement of closing inventory, overstatement of closing inventory, understatement of closing inventory. Talk about overstatement of sales, overstatement of sales, overstatement of sales. Talk about understatement of sales, understatement of sales, understatement of sales, understatement of sales. I want us to see and have a look at what will be the impact, what will be the effect of these items to our, what will be the effect of these items to our profit. What will be the effect of these items to our profit? So, at any given point, whenever we've overstated our opening inventory, the impact to our profit will be what? In the event that we've overstated our opening inventory, it means that at this point, what we've done, we are going to overstate our cost of sales. And if our cost of sales is overstated, the impact to the profit will be what? It will reduce our profit, meaning that it will lead to understatement. It will undercast our profit. So the effect to the profit will be understatement. It will lead to understatement of profit. It will lead to understatement of profit. It will lead to understatement of profit. And how will we correct that? How will we correct? To correct the understatement of profit, what will be required to do? Will be required to add it back. We will be required to add. That is correction. I'm not sure if you guys are viewing it there correctly. I can still adjust my camera so that all of us, we should have a view on that. Should have a view on that. You should have a view on that. Just a moment here. Mwalimu is adjusting his camera. Okay, so we are saying that in this case we're looking at correction. How to correct that correction. We are talking about correction. So, in this event, you are saying that in the event that we've overstated our opening inventory, overstatement of opening inventory will lead to understatement of our profit. And to correct that, we need to add back what? The understatement value. We need to add back the understatement value. That is one thing, my good students, that must always tend to stick at the back of our mind. Now, after we've talked of that, that should take us to understatement of opening inventory. In the event that we do have understatement of opening inventory, what will be the impact to our profit? Understatement of opening inventory, it means that we are going to understate our cost of sales. And if we understate our cost of sales, that means that our profit will have an impact of reflecting a higher profit than what it is. So in this case, we'll find that understatement of opening inventory, it will lead to overstatement of profit. It will lead to overstatement of profit. And to correct that, what will be required to do? Will be required to deduct. Will be required to deduct the overstatement amount. Will be required to deduct the overstatement amount. Will be required to deduct the overstatement amount. What about the impact of overstating our purchases? Overstating our purchases, or rather the impact of our purchases, will be the same as what? As opening inventories. So therefore in this case it means that if we overstate our purchases, the effect to our profit will be understatement. The effect to our profit will be understatement. And how will we correct that? To correct that, we need to add back that understatement, understated value. Understated value. We need to add back that understated value. What about understatement of purchases, my good student? This will lead to overstatement. This will lead to overstatement. This will lead to overstatement of what? Overstatement of our profit. And to correct that, will be required to deduct that overstatement amount. To correct that, will be required to deduct the overstatement amount. Then what about overstatement of closing inventory? In the event that in this case we have reflected, or rather we have overstated our closing inventory, this means that what will happen to our cost of sales? Our cost of sales will reflect a lower figure than usual. And if our cost of sales is low, that means that our profit will be overstated. So therefore, an impact of effect of overstating our closing inventory, it will lead to overstatement of what? It will lead to overstatement. It will lead to overstatement of our profit. So to correct that, what will be required to do is to deduct that overstated amount. We will be required to deduct the overstated amount. Okay. Now, what about understatement of closing inventory, my good students? If we understate our closing inventory, it means that that will lead to understatement of what? It means that that will lead to understatement. It means that will lead to understatement of closing, or rather of our profit. And to correct that, we will be required to add back that understated value. We add back, we add back, we add back. I know for sales, all of us, we are very sure of. I know for sales, all of us, we know the impact of overstating our sales to our profit and the impact of understating our sales to our profit. If I may ask that question, let me ask this question. Because I know all of you, you know this concept, right? What will be the impact of us overstating our sales? How will it affect our profit if we reflect higher sales than what it is? What will be the impact to our profit? Yeah, I'm pausing so that you guys should think about it and give me a solution. In this case, you'll find that the impact will be overstating our profit, sort of about overstatement. And of course, to correct that, we are going to deduct that overstatement value. We are going to deduct the overstatement value. Then what about the aspect to do the overstatement of sales? The overstatement of sales, my good students, will find that this will lead, understatement of sales, this will lead to what? Understatement of our profit. This will lead to understatement of our profit. This will lead to understatement of our profit. And of course, to correct that, what will be required to do is to add back. Now, the moment we are good in all these concepts, my good students, you'll find that working out now partnership, it will be very easy. And it as if at this point, as if we've also tackled partly what is required in taxation of limited company. That's the beauty part of this. So that for us to cement this knowledge, for us to cement this concept, my good students, I want us to handle an illustration question. This illustration question is going to come from our past papers. This question was tested some times back. That is a May 2017 question number 5. This is a question that Mwalimu will want us to handle. This is a question, conversion of a partnership into a limited liability company. That question was tested in advanced taxation, in this case which used to be known as advanced public finance and taxation. This question was tested in May 2017. I think it was a question number 5. It was if I'm not wrong, it was a question number 5. Question number 3. May 17, question number 3. May 17, question number 3. That is Wema and Nenda. And in that case, we are going to do that question in our next session. That question, we are going to handle it in our next class. So don't miss our next class. Don't miss our next class. Of course, you can get all these videos from our phone application. If you're having our phone application and you're our student, you know what we offer there, right? For those who have not yet downloaded our phone application, I'll want you to download our phone application, and we will meet there to handle this question, of May 2017. That is conversion of a partnership to a limited liability company. Thank you so much, guys, and let us meet in our next class. Thank you.